In this overview, we'll take a look at one of our top growth investing methodologies. In this approach, we're going to focus on a growth model that looks to find winning growth stocks over time. The model originated from the academic work and testing of Partha Mohanram, a professor at the University of Toronto. The key investing insight here is that although value stocks as a group tend to outperform growth stocks over long periods of time, some of the best performing individual stocks come from the growth segment of the market. The strategy overview is this. At a very high level, the strategy looks for low book-to-market stocks or high price-to-book stocks that exhibit characteristics via their fundamentals and the trend in those fundamentals that are associated with future growth. As I mentioned, the model is based on Partha Mohanram's academic research and testing. In his paper, Separating Winners from Losers Among Low Book-to-Market Stocks Using Financial Statement Analysis, he was able to construct a backtest of this strategy and showed that from 1979 to 2001, a portfolio that consisted of the top-rated stocks using this model produced a return of 20.3% versus 11.3% for the market over a 22-year period of time. The investment thesis is this. Expensive stocks generally tend to underperform the market, but by applying a series of fundamental strength and reinvestment criteria tests, this model can identify the outperformers within the most expensive growth stock group of the market. So let's look at the model in some detail. Mohanram developed a grading system. He called it the GSCORE, which effectively scores stocks based on profitability, cash flow factors, and reinvestment criteria. The GSCORE is an 8-point scale that is applied to the 20% of stocks in the market with the highest price-to-book ratios. So his initial cut of the universe was looking at the most expensive stocks in the market based on price-to-book. From there, the investment criteria Mohanram used can be categorized into 3 different buckets: profitability and cash flows, business and earnings variability, and reinvestment in the business. The first criteria is to screen for stocks that trade at the bottom 20% of the market based on the book-to-market ratio, which again is just the inverse of the price-to-book. So remember, this is looking to identify, at least to start, the most expensive stocks in the market based on that ratio. From there, the first set of criteria would be considered profitability and cash flow criteria. So this model looks at return on assets compared to the industry median. It wants to see return on assets above the industry average. It then looks at cash flow from operations to assets above the industry average. And then lastly, cash flow from operations to assets versus return on assets above the industry average. So one of the things that's unique about this model is the focus on comparing and rating companies against their industry peer group. Mohanram realized that stocks in different industries have different characteristics and growth dynamics. To handle this, the model compares stocks using these criteria versus the industry. Next, the model looks to reward consistency. So companies that are exhibiting consistent growth are more likely to sustain that growth in the future based on Mohanram's testing. The first criteria here is it looks at the firm's variance in return on assets. It wants to see that below the industry average. It then looks at the variance in year-over-year sales growth, and it also wants to see that below the industry average. Once we have that, we can now look to see if the company is investing in areas that can help generate and sustain future growth. So here, the model looks at R&D, capital expenditures, and advertising, and compares that spending versus the industry. So for example, the model wants to see R&D to assets, CapEx to assets, and advertising to assets above the industry average. Once we have scores for all those criteria, the model can basically generate a G-score. So companies that pass all 8, those are the top ranked companies based on this G-score formula. And those are the companies that the model keys in on and wants to hold in the portfolio.